Hey everyone, welcome back to the Investor's Guide to Joy. Today I'm here with great Grant Francke. So we're going to talk about the mindset to 100 plus doors. It'll be a fascinating conversation from like a single family duplex side of things. We'll also talk about some commercial properties as well. Talk about mindset, probably some lifestyle, maybe even some family. Grant, thanks for being here today. Excited to dive in with you.
Hey, thanks for having me. I'm happy to be here.
Yeah, you bet. So, okay, the mindset of 100 doors, fascinating concept, right? I believe everyone and their mom at some point wants 100 doors because it has, financial freedom sort of tied to it. I'd love to just dive in and see like, is this a myth or does it depend? What I mean by that is by having 100 doors, maybe for yourself or maybe for others, is that then by definition financial freedom or does it depend?
It very much depends like on the type of deal you get, right? Somebody could have 100 doors and lose $20 a door each month. That's not going to be financial freedom. That's going to be just a long-term investment you're playing. Like for me, the reason I started investing in real estate, I was a conductor for BNSF Railways.
Okay.
It's a great job if you're single, you don't have any kids. So once I started having kids, I was married. I was like, I
Sure.
can't do this schedule anymore. So my wife and I started looking for an avenue for me to get out of that. And we found real estate and have scaled that for that way. So for us, like it was all about cash flow. We're cash flow investors. So financial freedom with 100 doors, yeah, it's absolutely possible if you have cash flowing properties that make sense. If you're underwriting them properly, you're doing all your due diligence and doing things correctly, it's absolutely possible with 100 doors.
Okay. Is it then to say, so I, for example, have like a 3-year vision exercise and a number of different exercises on my website, but I love the number 100, right? Most people do as well.
Yeah.
Is then 100 the like at what point would you say is almost that threshold of financial freedom ish, right? Obviously it depends on your expenses, depends on lifestyle, depends on, expectations and a number of things. But where have you seen like for yourself, at what kind of number of doors is there like enough cash flow? Because I have other questions on the, specific type of cash flow you're getting from some of these assets, but really just trying to dive in from a mental perspective, like, is it actually 100 or do you really just need to do, 20 really silly well, right? And obviously it's not that specific number, but the concept of a number.
Yeah, that's a great question. So for me, it wasn't so many a number of doors, it was amount of cash flow per month. So what my wife and I did, we took the income I was making at the railroad, we factored in the tax benefits of real estate, write-offs, depreciation against her income as well. And we had a cash flow number. Like once I got to that number of cash flow, it wasn't so many doors, but it was more cash flow. That's when we felt comfortable calling myself financially free and able to leave the railroad. For us, that was around 40-ish doors is where I was like,
Okay.
okay, we're good with that. And everything since then has just been us like slowly scaling up after that.
And for context, is that 40 doors for just replacing your salary or for like the entire family, or what does that look like?
Just my salary. Yeah, my wife still has her W-2 job. She likes what she does. It doesn't really take away time-wise for what we do as a family. So we're still sticking with that for now. If that changes in the future, then so be it. But right now she's still at it.
So what the heck do you do all day? Just go to Dave Matthews Band concert?
I do a few Dave Matthews Band concerts, yeah. Otherwise, yeah, I'm just underwriting deals, still managing
Oh,
we manage all the properties ourselves. So I have a
okay.
VA that helps me with that. So we stay pretty busy with that. Otherwise, underwriting deals, yeah, just networking with people, brokers and sellers.
Okay. Yeah, that brings up another interesting point. So like, can you share a little bit more about like what your portfolio looks like today and what you hope or expect for it to look like in the, short or long future?
Yeah, good question. So right now we're hovering right at 100 doors. We've sold some off and we're buying some new stuff here. So in the next month or so, we'll be at about 120. It's mainly consists of only have 5 single families. The rest are 10 or duplexes, sixplexes, some 10-unit complexes sprinkled in there as well.
Oh,
For the future, I'm just calling it stable growth. Like I'm not going out there trying to stick my neck out for a D-class duplex. I'm fine with just waiting and buying the good properties that I know I'm going to want to hold for a long time
mm.
and not really just trying to buy everything we can. We're just buying good properties that cash flow.
Yeah. So I'd love to dive into cash flow, right? Especially there's a lot of history I could share from like my experience and what I've experienced, being former commercial real estate broker and then also just, single family investor like myself. For, cash flowing, are you mainly focused on the type of tenants, right? So think of, short term, midterm, long term type, even like house or not house hacking, rent by room, type
Right.
strategy, co-living. Is it that like the main focus? Is it location? Like what's your kind of recipe of sorts for investing in this sort of state of the market? Because certainly it's not like the 1% rule, back in the day.
Yeah, great. So we just buy boring duplexes that boring fourplexes, boring sixplexes, just your basic class B workforce type housing that somebody's going to move in. Maybe they're not married yet. They get married, they have a kid or two there, and then they're going to move on to a house from there. We
Mhm.
haven't gotten into the new like rent by room, pad split type of stuff yet. We
Yeah.
just find those basic workforce type of housing and we just stick with those. Location wise, so we're in Southeast Nebraska, the Lincoln, Nebraska area. There's certain areas in town we buy, certain areas in town we don't buy, but we're just looking for those like class B working force places that are going to be the bread and butter, and they're not going to have a whole lot of ups and downs when it comes to class A or class D type of markets.
Yeah. And are you investing there just because you live there or because the returns and, profitability of cash flow
Yeah,
are?
both. So yeah, so it's a really good market for cash flow. Like it's an appreciation side play, but it's a cash flow market. So we're lucky enough we live here. I don't invest outside of where we are right now just because I do manage everything and I've got the systems and the networks and the processes set up to be able to take on those properties with pretty well no problems, right? So if I
Sure.
was going to go invest in San Antonio or Spokane or something, it would take more work for me to get that done. And right
Mhm.
now we're really comfortable where we are.
Yeah. What is like average deal kind of like size and cash flow, just so we can all have an understanding? Because, I live in Austin right now, moving to Nashville, where I'm recording this currently, the very different type markets, even from like a California as well.
Yeah. So your basic duplex right now is going to be, 250, 300, 350 purchase price. And then your rents obviously, like we talked about earlier, 1% rule is pretty much done for at this point, but you're getting rents that are going to get in that closer to that 75, that 0.75% range. And you're
Mhm.
still able to cash flow pretty well on that. A vast majority of our portfolios come from off market deals. So that's just networking with sellers, some brokers, some bankers type of thing. So we're trying to get those deals because usually, like, as you know, like if a property gets on the MLS, it's probably not a good deal. It's been looked at by 20 or 30 people already and they've passed on it. So we're trying to get ahead of stuff getting on the market by either talking to the sellers directly or the brokers directly so we can try to get those low hanging fruit before they get on the market.
Yeah, sure. Okay, great. What has been your strategy for growth, taking out what I'll call the, greatest return of a lifetime, 2020 to call it 2022, at least for myself, or maybe even to today, right? Just most places have appreciated dramatically. What has been, the strategy? Every 3 to 5 years, you're kind of like refinancing, you're getting, a line of credit from investment properties, you're, stacking cash and then buying and leaving the properties alone. It's been a mixture. Like what have you done and have you experienced?
Yeah, so we've done a good mixture of all of them. So right back when we started, I was still like in the weeds of it. I was working all the properties myself. Didn't have any help with the VA, but we were able to do a lot of forced appreciation then by buying some of these properties that are, a little run down, lower rented. We were able to do some of that, refinance a lot of that stuff, and then pay off some of them. So then we have a line of credit against a few homes that are paid off. We use that a lot for going after new deals with down payments. Obviously, in 2020, 2021, we refinanced just about as much as we could to those
Mhm.
lower debts. Had some cash out there as well. Otherwise, it's just a big snowball, right? We take our cash flow from our properties, either invest them in the properties or we start nest egging up for our next purchase.
So lines of credit, paid off properties. What opportunities has that presented and challenges has that also presented? There's a lot of different philosophies out there. Think of, Dave Ramsey, and then think of, I mean, yeah, just even like hyper aggressive. Like honestly, I kind of consider, myself with this where it's like, yeah, get the second lien to then do this, to then have this, and then also, have this cash flow help pay off that in, kind of complexity of sorts, right? But the concept of paying off that, property that, let's call it, may have like a 6% loan to then get a line of credit that's like what, at a 10%? Like how does that justify or make sense, or what are you seeing with that?
Yeah, it's something we go back and forth on a lot. Like I'm definitely not in Dave Ramsey's camp of, pay cash for everything and don't have debt. We also want to have a healthy amount of debt. Good debt is in fact good debt. Like if you can get debt on something that's paying you cash flow, that's great. In the beginning, it was just more like when we paid those two properties off, we were still in the beginning and it had that security, that comfort of like, well, I've got these properties paid off. There's nothing else that can come and get them. And I could do that line of credit against them. So for me, it was just having that combination of both. We're still like very debt heavy. We do loan. Like the next loan we're doing is going to be like a 70% loan to value. So we're not pushing it all the way to 80, but we are still taking on debt because you have to in this business to grow.
Sure. And is that kind of your threshold rule of thumb is 70%, or where do you like to be at?
I mean, right now with interest rates where they are and like getting deals to work, 70% seems to make sense. Back in obviously 2020, 2021, I would have taken 100% loan to value if we could have, but just
Sure.
just where it is right now, that's where we're at is 70.
Okay. Yeah, makes sense. How often are you evaluating like changing lines of credit or refinancing or things like that? And is there a system to it of, hey, every year you kind of reevaluate, hey, when it gets to a certain point in the interest rate, or is it maybe more a value of a house type thing? Like what sort of levers do you have that I'm calling them, right? That you look at in some sort of cadence and then pull.
Yeah. So recently we've really been looking at return on equity. Like we talked about earlier,
Okay.
like there's been such a massive appreciation of everything. Even around here, it's a cash flow investment, but stuff has gone up so much. So we're looking at our return on equity. So how much equity do we have in these properties versus how much cash flow are we getting on them? Would it make more sense to sell them and 1031 into something that's a little bit bigger and a little bit more scale, which is the last
Mhm.
couple of deals we've done. We started selling some of our first duplexes and we're 1031 into a 17 unit deal. So the big one for us right now, like lately, has been return on equity. A lot of our interest rates are locked in for another 6-7 years. So like we're just going to let those ride until that equity gets out of whack, and we feel
Mhm.
like there's a better opportunity somewhere else.
Describe more. What do you mean by locked in? So people have a good understanding of that.
Yeah, good question. So it's a commercial loan, so they're amortized over 25 years. So your usual loans are 30 years for amortization, and they're due in 30 years. These ones are amortized over 25 years, but they're due in 10. So at 10 years, we'd either have to refinance, sell, do some sort of capital movement there. So we've got those interest rates locked in for a while. So we're just going to ride those low interest rates and the cash flow that those create.
Yeah. Do you have any prepayment penalties on those?
No, those we were able. So that was back in when money was fun and banking was easy. Like we were able to negotiate no prepayments on those. So
Okay. Yeah. Is that what you would, or how would you recommend, or even what are you doing today in terms of navigating the market with maybe prepayment penalties, interest rates, balloon type products, like you're talking about in arm loans? What does that
yeah,
look like?
yeah. So the last deal we're doing now, we're having a tough time negotiating out the prepayment penalty because they do see interest rates going lower. So it's just something we're gonna have to deal. Like if I get this loan at 6% and it works at 6%, I've just got to know while I have this loan, I'm not getting out of it until the loan is due. And
Hmm.
so just building that into the business plan of like this is a 10-year play. We're going to keep this for 10 years. At
Hmm.
10 years, then we'll evaluate it. But for those 10 years, this is where we're at. Where before it was kind of easy. Every time interest rates went down by a point, you email your banker and they'd be like, oh, all right, yeah, come in, sign. We'll get the interest rate adjusted. So
Okay. Yeah. Is that then what you're focused on now is more those, kind of 15 plus units, or what's kind of been the strategy?
yeah, we'll look at everything. So like fourplexes are kind of my bread and butter. I like those just purpose built brick fourplexes. I love having those. They attract really good tenants, but we're looking at about everything we can right now just to find those diamonds in the rough and try to find the good deals that are out there.
Yeah, for sure. Talk to me a little bit about the story, right? So I definitely resonate with the being single type individual, making good money, saving, investing, growing, being. You've also then, become married and, have really a family now. How's your mindset changed through that process? Let's kind of start there. And mindset specifically on what's possible as well as how you are, viewing money. Is it always a desire for more, or is it better allocation, or like how do you define or use money as a tool kind of over that thought process?
Yeah. So in the beginning, money was a means to an end for me. The cash flow was a means to an end of leaving the railroad. Like my son was 1, my daughter was 6. I was like, I got to get out of here. I can't, miss everything. And it was really the realization that the cash flow was the tool to get me out of there. Where transition to now, it's more of like a tool that has bought me time freedom. Like now we can take the trips that we want to. I'm not beholden to a boss anymore. I don't have to ask to go on vacation. So it's really transitioned into that time freedom tool and what that can provide for our family. I mean, we'll be home more. Like I help out with, I do dinners, I do lunches, I do all that for my wife to make it her job easier
Yeah.
And because of that real estate, I got that time freedom where I can focus on the family more.
Yeah, that's incredible. What has that process been like for, let's start here, like, with your wife. So you mentioned that some of the properties you own are, with your wife, and then you've done, JVs and other deals with, people. What were those like interactions and conversations like as you go from one kind of salary to two? Was it, hey, let's reduce all expenses to just be able to live off one, and then taking that chunk of change and then investing it? Or how did you approach that kind of tactically from, saving and investing and, kind of growing this portfolio?
Yeah. So in the beginning, like when I was still at the railroad, those last couple of years where I was grinding on the real estate and the railroad, I went to, so it's a union job. So you can kind of bid around to different spots within the job. I went to the lowest paying job that I could for a couple of years. And we decided like, if we can live on this amount of cash flow, then once we get to that cash flow on the real estate with a little bit of buffer, we're going to be good to leave. So we really readjusted like our spending then. And then once we left, we were able to kind of keep that spending at that level until we were able to scale up the real estate side. That helped us in multiple ways, right? So I had while I was on the lowest job, we were still cash flowing a decent amount. So we are saving up that money and stockpiling that money for when I did leave. We were able to keep scaling up the railroad or the real estate side.
Yeah. Lowest paying job. Like, was that just because it wasn't as time involved or what?
Yeah, just different jobs have different agreements. Like it's all union stuff. So I was just so it's just the lowest paying job. It's just you had the worst rest days, and you didn't really. It was also like the easiest labor wise job, so they didn't pay as much. So we
Sure.
just went to that just to try to get that mindset down for us.
Okay. So it wasn't like so it was specifically like a mindset thing that you did to force kind of expenses and and really kind of grow from that, is what it seems like.
Yeah, we just kind of realigned our spending and our lifestyle at that point to try to get accustomed to when I did leave the railroad that we didn't have that huge buffer that I could just bid to the highest paying job,
Mhm.
whenever I wanted to. This is what we're at. This is where we're going to be when I leave.
Sure. Was it more on the concept of like consistency as well?
Yeah, like I said, because like at the railroad, if I didn't like that job, I could bid to the highest paying job the next week and make a ton of money.
Mhm.
Where like just if I could consistently do this for a couple of years, and then once we left the railroad, we didn't know any better at that point. We just kind of kept on that same lifestyle.
Sure. Okay. In terms of the mindset around now, with kids and kind of time freedom, what is that, like, or how are, I guess, you balancing and structuring that? It seems like you're able to kind of do it all, but in the sense of doing it all, you also kind of get nothing accomplished, right?
Right. Yeah. So the time freedom for us, like we had enough cash flow in the last couple of years. We brought on a full-time VA. So like I said, I manage all of our properties ourselves. So she's able to take all the management side off of my back. So she's doing all tenant interactions, from leasing to maintenance to listings, all communication with tenants. She takes care of that now. So with that, like I said, with the time freedom earlier, our cash flow has afforded for us to bring on VA to take more off my plate and focus more on scaling the business, working on it instead of in it, like everybody always says. And then
Sure.
also more time with my family.
Awesome. In terms of hiring a VA, what is that process like? Like, what did you evaluate to know when and how to hire one?
Yeah, I probably waited like 20 doors too long. For me, I knew I needed some help when I was turning down deals because I didn't want to manage them. Like I was passing up on stuff because of the work it would cause me. So then if I realized like, well, I'm in that plateau where like either I'm not going to ever grow again, or if I'm going to grow, I'm going to take this leap. So we were able to go to a company that actually trains VAs for property managers. So she came to us all trained up on fair housing laws and basic knowledge about rental property stuff. So we just had an SOP and I gave it to her. Took a couple weeks for her to get on board, but she's been great since then. So
Well, yeah. What is the next kind of vision of where you see your mindset, going, right? You mentioned how you intentionally shifted that from, being in the railroad and going for the lowest paying job. Is it the next challenge or the next opportunity, or what does that look like today?
yeah, I don't really have like I can't say I have a goal of doors or anything like that. It's just controlled, stable growth of like if a deal works, all right, we'll take it on. If not, no. We have a very clear buy box, very conservative underwriting. So we
Mhm.
look for those things. And if it matches that, if it checks all the boxes, all right, we'll do it. But I don't have a goal of like having 200 doors by the end of next year. Like that's just a
Yeah.
recipe for disaster in my head of then you're going to start buying stuff you shouldn't. You're going to start going down avenues you shouldn't. You're going to get that shiny object syndrome where we have a buy box. If it fits in that buy box, all right, we'll go. If not, then we pass on it.
Yeah. What does the buy box consist of? Is it like simple as like purchase price, rent in the area, things like that? Or is it more extensive and there's like 20 different, pieces of criteria per se?
It's pretty basic. Cash flowing residential properties in our area. That makes sense. So I'll look at everything from a duplex up to 200 units. Like I'm going to underwrite everything I can, but
Mhm.
it's just got to check those boxes of being cash flowing in our area, in our spots we want to buy.
Sure. Okay. You've also invested in some syndications as well.
Yeah, so we've done a few passive investments in syndications. They've all actually been in the area, just matter
Okay.
of fact, like it just happens to be in our area. But just
Okay.
some strip mall stuff, a couple restaurant type of buildings too. So
Awesome.
yeah.
What was that kind of identification, like to find or learn more about them?
Yeah, so they're actually people that run the syndications are people that I know just through real estate stuff in the area. So I
Okay.
felt really comfortable investing with them just because I know they're good people. I know how they operate their business. So
Yeah.
I was got pretty lucky with that. I didn't have to search out and find a syndicator that I could trust with my money.
Yeah, sure. And what has then been like the outcome of some of these syndications? Are they or equity multiples and cash flow, or like I guess describe a little bit about what they
They're
are?
yeah, they're supposed to be a little bit of both, right? It was a
Okay.
rough time the last couple of years, so we've gotten a few distributions from them, but the money I gave them, I just set aside. I'm like, I'm not going to worry about this for 5 or 10 years. Like, I'm not calling them being like, hey, where's my distribution? Like, I know the type of people they are and how they operate their business. So that's why it's like it's nice when you do invest with somebody if you do have that connection. So you're not like worried about how they're operating their business. Like I understand how it works and things are going to go up and down, and it's an investment. It's not. I'm not giving them my money expecting interest payments every month. It's an investment in the property and them.
Yeah. Since it's local, do you have any like cross collaboration with them?
A little bit, yeah. So one of the guys, like I do some private, we're going to invest with him with some private money lending. Just otherwise, like, we always see them each other at meetups or go golfing with them or something like that.
Sure. Okay.
Yeah.
What does the future look like for, syndications as well? Is that something you're consistently considering? Because it doesn't necessarily fit your buy box because it's not, yeah. So what does that
Yeah.
look like?
It's something I'm open to. Like there's certain operators that I would trust with that. I do, if I had capital to spend myself versus capital to invest in a syndication, I would invest in myself first. But if we
Okay.
had a chunk of capital and I had a good syndication opportunity come up, I wouldn't hesitate to invest in that.
So why is it like 100% yourself, then something else, or is there some sort of percentage split? Like, talk to me about that.
For like in the future.
Yeah, just in the sense of, I mean, even today, right? But it's this concept of like, if you had, the 100 grand, if you will, to be able to buy another, cash flowing property that you would, own, manage, have yourself, or, put into a syndication, like, is it 100% you first and then potentially that, or is it kind of like a, 60/40, it depends sort of piece, and a couple things I want to dive into on this.
Yeah. So right now it would be 100% on me just
Okay.
because I know I have that capacity to bring those properties on and manage them myself and with my systems and processes. In the
Mhm.
future, I hope it gets to the point where I would rather invest in syndication, right? Just that passive income. Again, like if I had the $100,000 and it was a smoking hot deal on a syndication versus like an okay deal for me, then I would do the syndication. Like I'm not adversely looking at syndications versus myself. It's just
Mhm.
wherever we can get the best deal at the time.
Sure. Yeah. And that's one thing I've seen from being a capital raiser is also syndication investors that you're not necessarily getting those deals infrequent all the time. So it's a
Yeah.
lot easier for you to go out onto the, Zillows of the world, or especially like, pocket listing private market sort of stuff to evaluate and understand than necessarily if, again, you meet someone new or you're on an email list or something like that, that you also, trust for it. One other piece I wanted to talk through, on this concept of like the mindset of 100 doors, and also investing in syndications. So trust of person and expectation, yeah, in some ways like expectation that they're able to execute as it relates to the operations of the product
Yeah.
and the product itself, right? Like if you have a really good operator, but it's in retail and retail, goes to hell in a handbasket, like, man, you trust them, they operate well, but market, kind of says otherwise.
Yeah.
What is that, evaluation and like experience like? I want to kind of talk about each sort of piece. So first, in terms of like trust of people, what does that, look like for you? Or I mean, said another way is almost like, what is that like trust box like, right? Is it just they like smile and shake your hand? They, compliment your shoes, like, buy a dinner and expect nothing in return? Like, what have you really found to then say, hey, like without a reasonable doubt, like I then trust this person?
Yeah. So for me, like when I explain to people too that like have asked to invest with us or ask this type of question, like you're really getting into a marriage with this person. Like you have to trust this person like you would be trusting them to get into a marriage with them. It's
Mhm.
not unless you're doing a 6 month deal where it's a flip. You're going to be in there for the long haul with them. So you need to trust their character. You need to trust how they operate, and you definitely we've all seen in the last couple of years. They need to have a track record. They
Mhm.
don't just need to be a social media influencer that got bored with what they were doing and went out and raised $20 million to buy an apartment in Dallas and then lose it after that, right? So you got to be able to trust the person and know what they're doing and hopefully have some sort of background check, or not background check, but like be able to see some past work experiences with, or even talk to people that invested with them as well.
Yeah. Yeah. Former investors is a key piece. Has that been your experience as well as like talking to former investors?
Yeah, so the group that I invest with, I knew one of the capital raisers, and then I talked to a few people that I've worked with them before. And
Yeah.
communication's key. They always are good at communicating. Every quarter we get something from them, just explaining what's happening with this spot and this spot. So that's something that's can be said too. Like if you keep your head in the sand and don't say anything, things can turn ugly pretty quick. But as long as you keep that open line of communication going, you should be in a pretty good spot.
Yeah, certainly. What would you say are questions that you ask or that you've heard others ask these type of syndicators to really get an understanding of, trust, their track record, and maybe like other things?
Yeah, it's just some past deals they've done, especially if they've gone full cycle with them, right? If they've done the first syndication, but it was just what they bought last year, like then that I'm kind of a little bit weary of that. But I'd like to see
Mhm.
them go full cycle and see the full business plan of how it worked out from where they started to where they ended and the exit cycle of how it worked. And you can get that from the syndicator or, like I said, talking to other past investors and try to get an idea that way.
Yeah, certainly. Have you found that yourself or maybe even others are less hesitant on, say, if they have like one good deal under their belt? Or are you looking for some sort of threshold that they have like two to four, or what is that like? Or does it depend maybe on the person as
Yeah,
well?
I think it depends a lot on the person and the feel you get from them. Like you can usually tell if you've got somebody that's full of crap right away, right? So if you feel good about the person, they've done two or three deals, then all right, that's good. But if I'm weary about them and I don't really trust what they say, and I don't know if I trust who they're sending me to as their references,
Mhm.
then I'm going to want to see more actual data and more
Sure.
deals done.
Yeah, makes sense. Last piece is then that product aspect. So, like, how are you evaluating, and this beyond just syndications, right? But like, how are you evaluating investing in that retail strip center versus single family versus kind of the plexes and smaller multifamilies that you are?
That's the one thing I do like about the syndication is that's what these guys do, right? They do really good at strip centers and these little restaurant areas. I don't do that, and I would love to have more exposure to that and self storage. So if
Mm.
I can give my money to an operator that does a good job at that, and that's their specialty, that's perfect because I don't want to go in and try to learn how to do that. I've got enough going on with what my business does. So like when I'm evaluating my buy box, like personally, yeah, it's that residential, two to whatever unit. But if I'm, looking at a syndication, I would much rather invest in the stuff that I wouldn't invest in personally.
Yeah, for sure. Why have you stayed in the single family plex and small multifamily space? Why not go to the 20 plus, 50 plus type of products?
Yeah, it's something we've been looking at. I've been underwriting those, especially here the last couple months more. Before, like in 2020, they were just like nothing made sense. Those 2022 vintage era deals are just like I just think people overpaid for them. So when I had the systems and processes in place to scale that high and that quick, nothing made sense. So right now things are kind of starting to pencil out. Like I said, we're going to do the 17 unit deal and we're
Okay.
underwriting some other bigger deals now. But when I had the processes set up to do that, nothing made sense. So now things are kind of starting
Okay.
to get to that point.
Yeah. What would you say from your experience is the threshold of when to have a part-time and full-time dedicated property manager to a united property?
Yeah. So for me, it was like 75 doors, I think was probably when I should have brought Kay on. And I brought her on when we had 106. So
Okay.
like that 75 door mark was good for me. Here in Lincoln, like we're pretty dependent on the weather, right? Like so winters are slower, not as many people are moving when it's 10 degrees out and snowing.
Yeah.
And springs are more busy. So like for me, it was like bringing her on, am I going to have enough for her to do? But once we had everything set and those processes going, she was able to come up with some different ideas too of like, hey, I could be doing this, or I could be trying this out, or we could try these things out. So bringing on that help at 75, I think would have been more beneficial for me.
Okay. Gotcha. And then as you're, underwriting these, deals and maybe the 50 plus or, things like that, I'm just going to guess that you're using the intention of the underwriting is to have a dedicated property manager, or what is that kind of back end evaluation? Are you getting another K, or is that just like giving what you have? What's that process like?
Yeah, right now we're just keeping it under like our company. So we would do a self or a management fee on the deal and just keeping it in house with Kay. And then we're hoping at some point we can scale and bring on like a full-time maintenance guy or like a construction division of our company, but we're not quite there yet. But we probably could be. I just need to make that decision.
Sure. Okay. Yeah. What would you say is like the biggest thing you've learned from this path of like 0 to 100 doors?
Biggest thing I've learned, probably, I mean, it's going to go back to like my why. Like if I wouldn't have had like why I was doing it, I probably would have failed multiple times because like times are going to get tough. Like pipes are going to freeze, ACs are going to go down. But like I knew why I was doing it. And that was to get that financial freedom, which turned into time freedom with my family. So like making sure that I had that, and like looking back the last couple of years, that's helped me more than I knew it did when I had those tough times of being like, all right, I know why I'm doing this. So we can keep trucking. We got the reserves. It's fine. But
sure.
If I wouldn't have had that, I could have had a bigger mental issue than I did.
Yeah, sure. Certainly. What would you then say is also like have you changed how you view and spend money?
Yeah, it's like we talked about earlier, it's more of a tool, right? Like I'm not gonna say money is infinite, but like money is a tool to buy you happiness and buy you and do those things. And we now purchase assets to create that money that can create that time freedom from us. So it did shift the view of money for me. And like that goes back to reading Rich Dad Poor Dad and all those game-changing books that you read right when you first start investing. So it kind of, I would say it proved me more of a tool than anything else.
Yeah, certainly. No, it's great. For this to say like this is like the guide to joy, how does joy then show up to your life as it relates to, yourself specifically, your, family, your marriage, and also like your kids? How have you found that to, change over time as well as you've, increased this portfolio and changed what and how you've invested in?
Yeah, it's just the time, the amount of fun times we've been able to have, the trips we've gone on, and then like on a deeper side, like showing my kids like you can do anything you want. Like I didn't go to college; I just went to I did a semester of college, and then I went to the railroad. So like I don't have a 4-year degree, but I've got this business that I built up, and showing them that you can do like anything you want, just as long as you put your mind to it and know why you're doing it. That's been really cool for me. Like showing my kids the business I built and them seeing the logos around, and like we'll drive around like, oh, that's one of your apartments. I'm like, yeah, we own that apartment and people pay us to live there. So
yeah. No, that's awesome. Yeah, it's cool to have that kind of shareability and perspective for your kids as well. That's great.
Yeah.
That's great to hear. For this, right? So this is like the guide to joy. And so what like mantra, mindset, perspective, piece of advice of sorts would you put in the guide from your experience?
Yeah. So I would say it's a quote from Henry Ford. I think it is Henry Ford. Where you think you can or you think you can't, you're right. So like if you have the right mindset and you go into it the right or the wrong mindset, it's going to determine the outcome for you. So we even talk about that with our kids, like with sports, like, oh, I don't think I can, I'm not going to play this game, or I'm not very good at baseball. Well, if you tell yourself you're not going to be, then yeah, you're not going to be. But if you think you can, then you're going to be able to do it.
Yeah, you bet. What's one thing that you feel like you tell yourself that you think you can't?
Ooh, I can be pretty good at self-sabotaging. So if I got a deal that I'm like, I can't do that. That's maybe too big. I can fall victim to that pretty good. So making sure I stay on top of that and realize when I am doing that, and I kind of self-right myself.
Yeah. You've probably overcome this a time or two, like is tactical things or perspective that's really helped you overcome or maybe even soothe those feelings or emotions?
Yeah, just going back to the basics, like, okay, I don't know if I can do this deal. It's too big. Then I break it down like, okay, here's the cash flow. Here's what our cash on cash return would be. Here's the management aspects. This is the amount of money we need to come have 5 partners find in, and just breaking it down. So it's not this huge thing. It's just, okay, it's much smaller. It's still real estate. We're still buying a building. We're going to get a loan. It's not a whole lot different than the duplex, but it may seem bigger, but it's all the same process.
Yeah, no, that's epic. Awesome. Well, thanks for coming on, Grant, sharing your perspective of, mindset of going from 0 to 100 doors. Really appreciate your insight and the progress you've made along the way.
Yeah, you bet. Thanks for having me on.
You bet. Hey, one last thing before you go. I wanted to share my mission while on this earth, and it's to help educate investors about different opportunities, share mindset tips on how to change our perspective, and different things to really experience more joy in our lives. If this resonates with you at all and you enjoyed this episode, please share it with friends and others to help grow the community around the Investor's Guide to Joy. Leaving a 5-star review also helps grow the show and get connected to more people and share our experiences along the way. Thanks so much for joining, and can't wait for you to listen to the next episode.